Now moving on to the fourth transaction. So let's say in October 2012, so the next month, you made revenue of $5,000 and paid rent, interest, and utilities of $2,000, $100, and $1,000 respectively. In addition, you need to pay $800 for personal rent where you live. You take $800 out of the business to pay this. All transactions are cash. So there's a couple of new things going on here. Notice how instead of rent, there are more expenses to consider now. We got this interest and utilities that I added as well. And then there's also this additional transaction that's sort of unique that we haven't covered yet, where you have to take $800 out of the business for personal rent. And actually with that transaction, we're going to be introducing a new statement of retained earnings. But before dealing with that personal rent transaction, I want to deal with all this stuff beforehand and how it's going to affect the balance sheet. Notice I have the balance sheet here from September 30th, 2012. And actually, first thing I want to mention is, let's say this is September 30th, 2012. That's the same balance sheet that's going to be on October 1st, 2012. So the balance sheet at the end of September, that's the same as the balance sheet at the beginning of October. So we could actually change this date since we're dealing with October in this transaction to October 1st, 2012. And what we're going to be doing is making, like we did in the previous transaction, an income statement. But now it's going to be for October. So we got Ice Cream Incorporated, we got income statement, and then we have for month. Remember, an income statement is for a period, during a period of time. So it's going to be for month. You could write of October. As I mentioned before, you could also write for month ended October 31st. You would put the last day of the month. I'm just going to put for the month of October. And an income statement, what is it? It's revenue minus expenses equals net income. So we'll have our revenue, which we are given, it's $5,000 here. And then we have our expenses, but notice there are multiple expenses. So I'm going to put a title, expenses, and then I'm going to put the list under here. So what do we have? We have rent, we have interest, and then we have utilities. So the rent is $2,000, so that's going to be $2,000. The interest is $100, and then the utilities is $1,000. Remember, we're subtracting those from the revenue. So when we subtract those, what do we end up with? We end up with our net income. And hopefully our net income is positive. It means we're making a profit for that period, for October. So we'll have 5,000 minus 2,000, which is 3,000, minus 100, which is 2,900, minus 1,000. That would give us 1,900. And so that ends up being our net income for October. And so where does this net income flow to? Remember, it flows into retained earnings. So we would add this 1,900 to this previous retained earnings amount of 2,000. So if we're going to be making the balance sheet now for October 31st, 2012, what changed on the left side? Well, nothing was mentioned about the machine, so that stays. But notice that all of these were cash transactions. So we received $5,000, but then we had to pay cash for these expenses. And so our cash goes up by 1,900. So on the left side, our cash balance is going to go up to $10,000 and $10,900. And then this flows into retained earnings. Remember what retained earnings is? It's the accumulated profit or losses over a company's life, the accumulated net income. So 2,000 plus this 1,900 now. So this here would be 3,900. And then notice if we add up the left side, it would be 18,900 on the left side, and then the right side would be 18,900 as well. Notice that the loan and the capital, those stay the same. And now let's deal with that last part of this transaction where you have to pay $800 for personal rent where you live, and you take $800 out of the business to pay this. Now, first thing I want to mention is if you remember from the assumptions that we went over, the underlying assumptions of accounting, there was the separate entity assumption. And what did we say there? We assume that the business dealings are separate from the personal dealings of the owners or of the shareholders. So notice that this personal rent, that's not part of the business. So we wouldn't put this rent of $800 as a business expense. It wouldn't go on the income statement. And so actually this first sentence here is totally irrelevant. Right? If they didn't have this second sentence where you take $800 out of the business to pay the rent, and they only had the first sentence, then it wouldn't mean anything. We don't do anything with that because remember, the business, this right here, and the personal expenses of the owners, they are kept separate with that separate entity assumption. However, this last sentence here, you take $800 out of the business to pay this rent. That's important. And in fact, this part isn't even important. It doesn't matter what you take the $800 out for. So they could say to pay your car, to pay their personal car off, or whatever, to make a personal payment on a bill. All that matters is that $800 was taken out of the business, and that we have to account for. And actually what this is called when money is taken out of the business and distributed to the owners, to the equity holders of the business, called a dividend. So you may see different definitions for a dividend. The way I like to think about it is just a payout to equity holders or to shareholders, or sometimes you'll see to owners. Remember, all those mean the same thing. Payout to equity holders from a company's earnings. Right? So the fact that $800 is getting taken out of the business, that is important, and that is going to affect the balance sheet. It is going to affect the business. But the reason why it's happening is not important. Okay, so dealing with the left side of the balance sheet, what's definitely going to go down? Cash is going to go down. We're taking out $800 cash. Remember, all transactions are cash. So 10,900, if we take out 800, then we'll be left with 10,100 of cash. So this left side went down by 800, which means this right side is going to have to go down by 800 as well. So what do we do on the right side? Which category is going to go down? Notice it's not going to be the loan of $5,000. It didn't say that we took $800 and paid off the loan, right? So that's going to stay at $5,000. It's definitely going to be something in equity. So what do? Do we maybe put a category here where we have like dividend, and then this would be a negative number of 800? Notice that would make the right side balance. But then we're making that equity account more and more confusing again. We're adding more categories, right? So it's going to be less understandable to that external user. And in fact, where the dividend gets taken out of is from retained earnings. Okay, so we can actually add a little bit more detail to this definition here. So a dividend is a payout to equity holders from a company's retained earnings. Okay, so what happens is the retained earnings goes down by 800. So 3,900 minus the 800, we would have 3,100. And now notice that both of these sides balance. They both add up to 18,100. Now notice how there's an interesting scenario, an interesting question that arises from what we just did. Question is, why do we have to pay dividends out of the retained earnings? Why did the dividends come out of the retained earnings? Why couldn't they come out of this capital account here under the equity section? And it's a good question, and I'm going to answer it briefly here. The short answer, if you ever see something like this on your tests, it's to protect creditors. So it's actually to protect anyone under this section, under the liability section. In this case, the bank that loaned you the $5,000 for the business. So how is that happening? How is dividends coming out of retained earnings protecting these creditors here? Well, if we go back to when we started this business, remember how you started it. You had $10,000 of your own capital that you saved, and then you went to the bank and got a loan for $5,000. And so you had $15,000 to start. Remember, this was the initial balance sheet when we first started the business. Now, this bank here, when they gave you this $5,000 loan, they obviously looked at your credit, they looked at your business plan, your plans for the future, to see how worthy you were of this loan, and they decided to give you this loan. But a big factor in their decision to giving you this $5,000 was you putting up $10,000 of your own money, right? Because the more money that you put up into the business, the more protected the bank felt with giving you a loan. They feel like there's more collateral there to work with in case something goes bad. And so if you put up $10,000, went to the bank, got this $5,000 loan, so you had this $15,000, and then imagine before you even did anything in the business, you took out the $10,000 investment that you had as a dividend. Well, that wouldn't be right, because the bank may have not given you this $5,000 initially if they knew that this $10,000 wasn't going to be there. And so the reason why the dividends have to come out of this retained earnings and not out of this capital is because if it was able to come out of the capital, then this sort of scenario would be able to happen. And these creditors here, the banks, would be more at risk. Doesn't have to necessarily be banks, anyone who gave you a loan. And so there's actual laws, there's actual corporate laws that limit dividends to the amount that you have in retained earnings. Under the equity section. And more specifically, now we're getting a little bit into corporate law, but the rule that that protects these creditors with limiting the dividends to retained earnings, it's called the capital impairment rule. If you want to look that up, if you're interested. You don't have to know it for this course, but that's the corporate law that that says dividends have to come out of these retained earnings. And if you don't have retained earnings, then you can't be paying any dividends. Remember, retained earnings, the way we differentiated these two categories here, the capital and the retained earnings was internally produced profit. while this capital here was external finance, which was initially you bringing in the $10,000. So if you think about it intuitively even, you shouldn't be really paying yourself money out of your business until your business is profitable, right? Until it's internally produced some capital, some profit from its operations. And remember, the retained earnings is the accumulated profit over a company's life. Okay, and so that's why dividends have to come out of retained earnings. Right, it is to protect these creditors here, because if you start taking it out of the capital, then the risk of default on this loan starts to increase, and it starts to put creditors in danger. So they put laws that protect those creditors in corporations. And so notice now that retained earnings, it's affected by multiple things. Before, with our previous examples, it was only affected by net income, but now notice it's affected by dividends as well. So any money taken out of the business is going to affect this retained earnings account. So remember, the retained earnings, October 1st, 2012, it was $2,000. And then it went up by $1,900 to $3,900, and then it went down by $800 to $3,100. So notice that that retained earnings has fluctuated a lot within this month, within October. And because there's multiple things affecting this retained earnings account, net income and dividends, external users want more of a detailed sort of report on it. And so there's actually another financial statement called the Statement of Retained Earnings that show how this retained earnings account changes. Right? So I'm going to show you how it works. So we have Ice Cream Incorporated, and then we have the Statement of Retained Earnings. Now, what's this date going to be? Is it going to be a single date, like the balance sheet is going to be one specific point in time, or is it going to be like the income statement over a period of time? And if you think about it, we said that retained earnings can be affected by net income, and net income is from the income statement. And so net income is going to be part of this statement of retained earnings. And because net income is from the income statement that's over a period of time for October, the statement of retained earnings is going to be for a period of time as well, not at a single point in time. So the statement of retained earnings, we're going to make one for month of October. Now I want to differentiate. Retained earnings is part of the balance sheet. So this account here is a single point in time, but the statement of retained earnings of how it changes is for a period of time, for the month of October. And so the way it works, its format, is we start with the beginning retained earnings for that period. So we would write retained earnings. And what was the beginning of the period? We're looking at October, so October 1st. What was the retained earnings on the balance sheet on October 1st? It was $2,000. And then what happened was there was net income, so we add net income. What was the net income? $1,900 from the income statement that we made before. So this here flows from the income statement. And then we're going to deduct dividends. And remember, the dividends that were paid was the $800. So this here is going to be $800. And what we end up with, our final result, is going to be our retained earnings for the end of the month, this number here. So it's going to be, or for the end of the period, we're looking at October right now, so it's going to be October 31st. So these dates here, it's always the beginning of the period you're looking at, then the end of the period that you're looking at. And so when you net all of this out, you would end up getting that 3,100, which is the number that we got here. So this ends up being that new retained earnings amount on the balance sheet at the end of the period. And now notice we could see how retained earnings changed. We added net income, we subtracted dividends. Okay, so that's that third financial statement. So what happens, I'm going to erase all this here. You know what? I'll try to keep this up. Yeah, I'll keep this here. So what happens is we have a balance sheet on October 1st. And then what happens is we create an income statement. And the way I like to think about it is this statement of retained earnings, it sort of connects this income statement for the period with the balance sheet at the end of the period. Oh, sorry, October 31st. Right, because we had the balance sheet out at October 1st, we made the income statement, remember, with the revenue and then the rent, the utilities, and then the interest. We got a net income of 1,900 from there. So on the income statement, the net income flows here into the statement of retained earnings. Then we have the dividend, and then we have that final retained earnings that flows onto this balance sheet here. So this was the flow or the timeline, quote unquote, that we went through for this transaction. Right, so the new thing that was introduced in this transaction was this here, this statement of retained earnings. So you start with the retained earnings at the beginning of the period, add the net income. This comes from the income statement, subtract any dividends, any payouts to shareholders, any money that you're taking out of the business, and then you end up having your retained earnings at the end of the period, and that is the number on the balance sheet at the end of the period.